Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at energy transfer.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below. So let's get into the analysis. I mean, when we look at energy transfer, we're not just talking about a big company.
No, not at all. It's a giant.
It's arguably the single largest and most essential midstream operator in the United States. And midstream is key here.
Right, that's the part that connects where the energy comes out of the ground to where it actually gets used, right? The pipelines, the storage.
Exactly. The toll roads of the energy sector. And their network is, it's basically irreplaceable. We're talking about hundreds of thousands of miles of pipelines.
Moving everything, I assume.
Everything. Natural gas, crude, and what's really critical for them, natural gas liquids, or NGLs. Plus, they own all the other crucial bits, storage, processing, and those major export terminals on the Gulf Coast. So if you mapped out U.S. energy production, their assets would be just like a web covering every important spot.
That's the perfect word for it, a web.
Right.
They connect the Permian, the Marcellus, the Utica, all the heavy hitters. And that integration, that's what creates their massive competitive moat.
Okay, let's dig into that moat a little. For someone who doesn't, live and breathe pipelines, why is it so hard for a competitor to challenge them?
It really boils down to two things: network effects and really high switching costs.
Okay.
So because they're connected to pretty much every basin and every demand hub, a producer can sign one contract with them and get their product almost anywhere.
So it's a one-stop shop.
Precisely. If you wanted to switch, a competitor would have to replicate not just the pipeline, but the storage, the processing, the export access. It's an almost impossible barrier to entry at that scale.
And that scale, of course, translates into some massive financials. I mean, looking at the top line, last year was what, around $89 to $90 billion in revenue?
A stunning number. It shows the sheer volume they handle. But what's even more compelling isn't the size of the revenue, it's the quality of the cash flow.
And this is where it gets really interesting for investors. We're seeing their adjusted EBITDA, which is, a good proxy for their core profit, is actually growing faster than their revenue.
That right there is the key. That's margin expansion. It's a huge signal.
How are they pulling that off?
It's classic operating leverage. I mean, they have huge fixed cost to maintain that network, but every additional molecule of gas they push through those existing pipes.
It's almost pure profit. The costs don't really go up.
Exactly. And on top of that, they're strategically focusing on higher margin businesses, especially those NGL exports and fractionation facilities. They're capturing more value.
So that's why we're seeing these really optimistic analyst forecasts, right? Something like 11 to 12% annual EPS growth through 2027.
It is. And that's a very, very strong growth profile for what most people just think of as a slow, utility-like company.
Which brings us to the balance sheet. Because to build all this stuff, you have to carry a lot of debt.
You do. It's the nature of the beast for infrastructure. Big assets need big financing. But the key word here is manageable. The question is always, how safe is that debt?
That's my question. We know it's necessary debt, but how risky is it for shareholders, especially if interest rates stay high?
Well, the risk is really mitigated by their clear commitment to deleveraging. Management is actively chipping away at that debt-to-EBITDA ratio. They're targeting the mid-4x range.
And that's considered a stable level for an asset base this big.
Very stable. And it all fits into their capital allocation strategy, which is very disciplined and very shareholder-focused. It's sort of a three-legged stool.
Okay, lay that out for us. What are the priorities for all that cash they generate?
Priority one is that big distribution. We're talking a high single-digit, sometimes low double-digit yield, and it has to be covered by cash flow. Priority two is what we just talked about, debt reduction. And third, any cash left over goes into disciplined, high-return growth projects.
So for an investor, this really is a rare combination then. You're getting a high-yield income stream backed by stable contracts with a very clear growth story on top of it. You get paid to wait.
That's the total return package right there.
Yeah.
And a big reason that growth story is so compelling is their geography, specifically their footprint on the Gulf Coast.
Makes perfect sense. The U.S. is basically becoming the world's energy supplier, and it all has to ship out from the Gulf.
Exactly. They are sitting right at the choke point. Global demand for NGLs and LNG is, it's relentless, and Energy Transfer is positioned to move it from the wellhead right to the water.
Okay, but we have to talk about this newer catalyst, the one that's been grabbing headlines. The idea that they are powering the AI boom. How on earth do pipelines become an AI play?
It's all about the massive energy consumption. It's a profound story. These new data centers, all the AI training, they need staggering amounts of power, reliable power.
More than the current grid can handle.
Way more. So you're seeing a huge surge in demand for new power generation, and most of that, at least initially, is going to be fueled by natural gas.
Ah, so Energy Transfer is building the pipes to feed these new gas-fired power plants that are popping up to power the data centers.
They're building bespoke infrastructure for it. They're leveraging their existing network to run new dedicated pipelines straight to these massive new power loads. It's like a specialized delivery service for the fuel that powers the tech revolution.
That really reframes their advantage, doesn't it? They're not just an energy company anymore. They're the backbone for U.S. energy exports and the fuel logistics for the domestic tech boom.
And that diversification is crucial. They're not just tied to one basin or one growth story. It reduces their risk profile significantly.
Let's pivot a bit to the market itself. How is all this fundamental strength showing up in the trading? The units in the mid-$16 to $17 range right now. What are the charts telling us?
It's interesting because the stability of their cash flows is kind of mirrored in the technicals. We're seeing what you'd call a grinding uptrend. It's stable, low volatility. It looks like gradual accumulation.
A grinding uptrend. You noted it's had, what, 15 green days out of the last 30. What does that signal? Is that just big institutions slowly buying in?
It signals disciplined buying. There's no panic. There are no speculative spikes. It really does look like institutions are just quietly building their positions for the long haul. You can see it consolidating right near its 50-day moving average.
Which is around 1670. And what does that consolidation mean for someone not watching charts every day?
It means the stock is holding a key level of support. It's building a base there, which is often a sign of strength before a potential move higher. And importantly, the RSI, the Relative Strength Index, is neutral. It's sitting around 48.
Meaning it's not overbought.
Not at all. There's plenty of room for it to run higher if a positive catalyst hits.
And that institutional buying seems to be backed up by what the insiders are doing.
Absolutely. Institutional confidence is one thing, but when insiders put their own money on the line, that's real conviction. We saw a director purchase 1.35 million units.
Wow.
That is a massive vote of confidence. That's management signaling they believe in the long-term story.
And Wall Street seems to agree. The consensus price targets are suggesting, what, 25 to 35% upside from here? It seems like the market hasn't quite caught up yet.
That upside really depends on a few near-term catalysts playing out, things we should be watching on the calendar.
Okay, let's talk about those. First up is the next earnings report. Consensus is looking for a pretty solid rebound in revenue, right?
Yeah, around 21.9 billion, up from 19.2 billion. If they hit that, it just reinforces that whole margin expansion story we were talking about.
And the other huge one to watch is any news on the Lake Charles LNG project.
That's the big one. It's a massive long-term driver. Now, the final investment decision, the FID, has been delayed to 2026. But any news before then? A new partnership, some regulatory clarity, that would be a huge positive catalyst. The market just wants to see progress.
And then there's the macro picture. You can't ignore interest rates.
No, stable or lower rates would be a massive tailwind for them for two reasons.
The first being their debt, I assume.
Right, it lowers their debt service costs. But the second reason is maybe more important for new investors.
Which is?
When bond yields fall, the high, stable, and growing distribution from a company like this becomes exponentially more attractive. It pulls in income investors.
We've covered a lot of the bullish case, but we have to talk about the risks. The delay of that Lake Charles project. That's a real risk, isn't it?
It absolutely is. It's a real concern, and it shows how hard these mega projects are to get done. But there's a strong mitigation here.
Okay.
The core business cash flows are not dependent on Lake Charles coming online tomorrow. They're driven by the existing diversified assets. And you could even argue that delaying the FID preserves capital and lets them wait for better market conditions.
And the other risk is that debt load we mentioned. If rates stay higher for longer, how much does that pressure them?
That's the structural risk for the whole sector. But again, the mitigation is pretty strong. Management is actively reducing leverage, and a huge portion of their debt is fixed rate and laddered.
We should define laddered debt. What does that mean practically?
It just means their debt maturities are staggered over many, many years. They don't have one giant bill coming due all at once. It protects them from short-term rate spikes. Plus, they generate so much free cash flow even after paying the distribution that they can fund a lot of their own growth.
So if we pull this all together, the thesis is really quite compelling. You've got this rare combination of scale, asset quality, and that high, well-covered income stream.
It's the definition of defensive infrastructure, but with some really exciting growth optionality attached.
And with the strong forecasts and that heavy insider buying, the current price does look attractive. It feels like there are multiple ways for this to re-rate higher LNG, the AI demand, the macro picture.
So for someone looking at this, what's the investment horizon? Is this a quick trade or a foundational long-term holding?
I think you have to see this primarily as a multi-year hold, maybe 3 to 5 years, to really see those big projects come to fruition. But that being said, there's also potential for a quicker, maybe 12 to 18-month re-rating toward those consensus targets. It's an investment that pays you very well to wait for that bigger story to play out.
The story here is the durability of core infrastructure cash flow paired with optionality from America's rising energy export dominance and the unexpected tailwind of tech-driven power demand. That optionality, paired with the dividend, provides a compelling risk-reward profile. If you want to keep track of these long-term plays, make sure you subscribe to Smart Wealth with Joshua.